In the given question, we are given the data for NJ Plumbing Incorporated's income statement, which shows a net profit before tax of $468, net sales of $7482, total assets for $3244, and the company's equity for 2010 as $1746. And now what we are required to calculate is, we need to calculate the return on sales ratio, return on assets, and return on equity. Now this is the given data: company's net profit, net sales, total assets, and equity. Now coming to return on sales ratio. Return on sales ratio is a ratio which is widely used to evaluate a company's operational efficiency. It is also known as firm's operating profit margin. The formula to calculate this ratio is net profit divided by net sales. So the net profit given to us is 468 and the net sales is 7482. So return on sales ratio will come out to 6.26%. Now next is return on assets. Return on assets ratio is an indicator of how profitable a company is relative to its total assets. That is, it gives us an idea of how efficient a management is at using its assets to generate its earnings. It is calculated by dividing the net profit with total assets. So net profit given to us is 468 and total assets as 3244. So the return on assets will come out to 14.43%. Now coming to next, return on equity. Return on equity is defined as the amount of net income returned as a percentage of equity. Return on equity measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. That is net income divided by equity. So it will come out to 26.80%. A company has a favorable position if all these ratios are higher, because it is better to have higher return on sales ratio, return on assets ratio, and return on equity.